Welcome to the Explainer. All right, if you're a government supplier or department in India, listen up, because your world of GST compliance is getting a major shakeup. We're going to break down the new GSTR 7 rules, and they're a pretty big deal. We're talking about a complete shift from a simple, high-level summary to a super detailed invoice-by-invoice report. Okay, so here's how we're going to tackle this. First, we'll talk about the old tedious headache, and trust me, it was a nightmare. Then, we'll dive into the government's new invoice-wise fix. We'll put the old and new systems head-to-head, see what this actually means for your business, and then I'll walk you through your new filing playbook. And to wrap it all up, we'll cover the high stakes. What happens if you get it wrong? Let's get into it. Right. First up, the old TDS headache. This was a reconciliation nightmare, and I'm sure for many of you, this is going to sound very familiar. So for all the suppliers out there, does this sound familiar? You get a single lump sum tax credit from a government client, and now you've got to match it against hundreds of individual invoices. It was a time-consuming, error-prone nightmare, right? You know exactly what I'm talking about. So what's at the heart of all this? Well, it's a system called TDS, which stands for Tax Deducted at Source. It's pretty simple in concept. Specified government bodies will deduct a little bit of tax, usually around 2%, when they pay you, the supplier. Then they just remit that amount directly to the government. It's all governed by Section 51 of the CGST Act. And here's where the problem really started. The old system was super easy for the government department deducting the tax, but for the supplier, it was a total mess. You'd get this one single consolidated TDS credit in your GSTR 2A with absolutely no link back to the individual invoices it was supposed to cover. This created a massive manual reconciliation burden that led to endless disputes and, you guessed it, blocked cash flow. Okay, so the government saw this huge inefficiency and, thankfully, decided it was time for a major overhaul. Let's talk about the invoice-wise solution they came up with. Now, this didn't just happen overnight. It was a really planned evolution. It was all formally announced with a notification back on February 11th, 2025. Then, starting in September 2025, this new invoice-wise reporting becomes mandatory for all TDS deductors. And the first due date to watch out for? October 10th, 2025. That's for the September tax period. So why the big change? Well, it's about way more than just adding a few extra fields to a form. This is a really strategic move. The main goal? To completely eliminate that manual reconciliation headache for suppliers. But it's also about creating this powerful, automated three-way check. Think about it. It matches the supplier's sales in GSTR 1, the recipient's credit in GSTR 2B, and now the detailed TDS in GSTR 7. It creates this self-validating system that ramps up transparency, helps prevent fraud, and brings TDS reporting in line with other modern systems like e-invoicing. And this next part really shows just how big this change is. Let's put the old and new systems side by side. It's like a tale of two different formats. Okay, just look at this. At a high level, the shift is, well, it's dramatic. We're going from a simple, consolidated report for each GSTIN to this incredibly granular invoice-wise detail. For the deductor, the compliance effort goes from low to high, no question about it. But for the supplier, that difficult manual reconciliation becomes simple and automated. It completely flips the script. And when you look at the nitty-gritty details, the change is even more stark. I mean, look at this. The old GSTR 7 needed, what, 3 key things? The supplier's GSTIN, total amount paid, and total TDS. That's it. One line per supplier. Now, the new GSTR 7 needs 6 specific details for every single invoice. You need the GSTIN, sure, but also the invoice number, date, value, the amount TDS was deducted on, and the TDS amount per invoice. The data volume just explodes. So let's get to the big question. What does this all mean for your business? Because this really is a two-sided coin. The impact is completely different depending on whether you're the supplier or the one deducting the tax. Okay, if you're a supplier, the deductee, this is a major relief. Honestly, it's a game changer. Reconciliation becomes automated because your TDS credit is now matched one-to-one with your invoices. This means your cash flow improves because you can claim and use that credit way faster. You'll have fewer disputes and your admin work slashed. Less time chasing paper, more time running your business. It's a huge win. But for the deductors, the government departments, the PSUs, it's a whole different story.
This is a new burden, plain and simple. We're talking about a massive jump in compliance effort and data entry. Your existing accounting and ERP systems, they might need some immediate, serious upgrades to even handle this. You'll need meticulous records because any tiny error in an invoice number or date could cause a rejection. The risk of mistakes just shot way up.
All right, let's get practical. How do you actually file this new GSTR 7? We're going to walk through your new filing playbook, and you've basically got two ways to do it: online or offline. First, the online method. This is really only for folks with a low volume of invoices. If you have just a handful each month, this could work. You just log into the GST portal, navigate to the returns dashboard, and choose Prepare Online for GSTR 7. The catch? In Table 3, you have to click Add and enter the details for every single invoice, one by one. After you've done that for all of them, you can pay and file.
But let's be real. For most government entities dealing with hundreds or even thousands of invoices, the offline utility is no longer a choice. It's an absolute necessity. It's your new best friend. You download the utility from the portal, you fill in all your invoice data in the Excel sheet, you validate it, and then you generate a JSON file. You upload that single file to the portal, review the data, and then you're ready to pay and file. It lets you do everything in bulk, which will save you an incredible amount of time and cut down on errors.
Okay, last section, and it's a crucial one. Let's talk about the cost of non-compliance. What happens if you get this wrong? Because, and I'm not exaggerating here, the consequences can be a real domino effect of problems. First off, there's a late fee. 200 rupees. That's per day for every day you're late filing. It might not sound like a huge number, but it starts adding up from day one. Now, that daily fee is capped, but the cap is 5,000 rupees per return. So while there's a ceiling, it's a cost you absolutely want to avoid. And it gets worse. On top of the late fees, if the TDS you deducted isn't deposited on time, you get hit with interest. We're talking 18% per year. That can really hurt. But honestly, the single biggest risk here is something I call the domino effect. The GST system has a hard and fast rule of sequential filing. That means you literally cannot file this month's return until all of last month's returns are filed. So if you mess up and delay your September return, you are blocked from filing your October return and your November return. One delay can freeze all of your future compliance, causing penalties to just cascade and creating a massive compliance crisis. It's operational paralysis. So what's the big takeaway here? This new GSTR 7 mandate is a trade-off. It's definitely more work for the deductors, a lot more work, but in exchange, it creates this transparent, efficient, automated system for suppliers. It's a fundamental shift in the GST ecosystem, no doubt about it. So the question is all that extra work now worth the promise of total transparency later? I guess we'll see. Thanks for joining me on The Explainer.